Right, I think we are there. It's 11 o'clock. So good morning, everybody, and thanks for tuning in again. So we've got a bit of news to run through before we talk to Anand Gauld of Patria Private Equity. But news first. So I've picked out 4 stories from this week. I'm going to start with VH Global Energy Infrastructure, where, as you can see, is in the normal pattern with the renewable energy sector. We've seen quite a big widening of the discount over the past sort of couple of years, and that's left it trading on a bigger yield, which I suppose is helpful, but nevertheless people are a bit fed up. So the manager decided, or the board decided, to talk to shareholders, and the feedback wasn't great. So basically only a minority of investors wanted to keep it going. So they're now proposing a managed realisation process for the assets, and then obviously that needs shareholder approval if it's going to happen. So they've got quite a few reasonably mature assets which are going to be quite easy to sell. It is possible that somebody would buy the entire portfolio, but I think that's very unlikely, and I think they do too. They kind of acknowledge that part of the issue is the diverse nature of it. So in the meantime, they're going to keep paying quarterly dividends, but obviously as they sell assets, the income to fund those goes, so that might fall over time. They think they can actually get the whole portfolio realised within 3 years, and they're actually saying that we think we can get a reasonable result for shareholders, even for those that paid £1 for the shares. So the existing manager will do the job of realisation, with some new fee arrangements. So the proposals, okay, so the existing fees you've got there, sort of a tiered fee. There's 412 million of net assets at the moment, so that works out at 3.958 million, I think, by my calculation. They're actually proposing a higher base fee. Now, I was quite surprised by this, but the argument is it's sort of the manager's going to have to sort of work quite hard to get it all realised, because they're going to do it in a shorter time frame than it took to get it invested. I'm not completely convinced by that, to be honest, but nevertheless that is the proposal. But obviously on top of that there's a performance fee based on how much they hand back to investors, and again I think this isn't particularly ambitious, so it's complicated too. And not completely clear what's going on here. Basically, the faster they get the money back, the lower the fee, the lower the NAV reference amount can be. So if they hand back 90% of the money in year 1, then there's sort of 5% available to cover a performance fee. And then they get a percentage of that, and then those percentages change over time. So you'll see there that if they sold the whole thing for asset value, they'd actually get 20% of all the returns. If they sold the whole thing for asset value in year 1, they'd get 15% of all returns above 85%. I just think this is a particularly challenging hurdle. But there we go. This is what they put forward. The board's tried to justify this, and there's some words around that there. And also, it seems that shareholders are quite frustrated, and so therefore prepared to take a haircut to get the cash back. As I say, I'm not completely convinced that this is the right incentive structure. Third Point Investors, which has also been trading on a big discount for quite a long time, as you can see there, has come up with a slightly odd proposal. So it's saying we want to merge with a reinsurance company that another partner of Third Point owns at the moment, which would effectively increase the Third Point stake within the fund, diluting down the external investors. This is a business that they want to grow quite quickly to about $5 billion annual premiums by 2027. and the capital for that is going to come from the existing fund. And so basically, they've got a portfolio of assets now within the Total Opportunities Trust, and as they're going to sell those, so we're going to redeem assets from that to fund the expansion of the master fund portfolio, and they want to transition that business to a pure play insurance business within about 3 years. They've got a guy running this business already, so he will be CEO of the combined company. So this will stop being a fund and become really just a quoted reinsurance company. And they reckon they can make mid-teens return on equities on it, and actually we end up being valued at premium to book, premium to NAV, which would obviously be great given where we are. However, that's a big departure from what it's doing now. It's understandable that some shareholders will want to exit. They're proposing a tender offer of $75 million. But the problem with it is that they're proposing to do that at a 12.5% discount. And I just don't think that's on, really, because this is a complete change of strategy, complete change of risk profile. I think it's reasonable that the people who want to get out should be able to get out. Strangely, Saba is on the register. It was quite small, only 1.2%, but they've actually been to talk to them and got an agreement for them to support it. But AVI owns 7.1%, and they are very much against the proposal. So I've given you here the whole text of what AVI have said. It's really quite damning. I'll let you sort of read it in your own time. Basically, they're saying, yeah, you're just aping what other people have done before. You're really coming late to the party on this. It's all very well to say it's going to be trading at NAV and make sort of high returns. I don't think there's any guarantees of this. They think that the whole thing is conflicted in the way that the people who are recommending the transaction will actually end up being involved in the new business, and they don't even think the broker is entirely impartial either, and so they're urging people to vote against the proposal. And then there's a debate then also about whether the third point should be allowed to vote stock or not. So I think this sort of row is going to run for a bit yet, and we'll see what happens. I wouldn't be surprised if it goes through, but nevertheless, the people shareholders are going to be quite unhappy about it. I would vote against, I think, and looking at all of this, I just feel that because it's such a complete change of strategy, you should be able to get out at NAV. Riverstone Energy next. Another big discount that's persisted for a very long time, but they have been slowly shrinking it. So the market cap's now down to 200 million. It's stuck on this big discount, which is unfortunate. And the board and the manager have decided it's now time to wind the fund down. Obviously, that needs shareholder approval. And the manager is saying, well, we will do this for a lower management fee of 1%, down from 1.5%, which all sounds great so far. But, and there's a big but, they also want to get the termination payment that they would have got if somebody had come from outside and beaten the thing up and fired the manager and tried to take it over. So I just don't think this is on. It's really quite greedy. 7.5%. So basically what they're saying is straight away, as soon as people approve this deal, they get 7.5% of all the assets apart from the unquoted stuff. Then the unquoted stuff will be turned into cash over time, and then they get 7.5% of that. And if you said they do it NAV, that's $21 million. I just don't think that's right. And I understand why you want to be protected if somebody attacks you from outside, but if you're the person who's putting your hand up and saying, we want to wind it up, I don't really think you should be entitled to this. But again, I very much doubt whether shareholders will be able to do anything about it. Then lastly, JPMorgan Indian. You can see there another chart where the discount's been quite wide for a very long time, and it sort of suddenly comes in at the end there. In fact, it's going to even higher than the band there. That's unfortunate. The Morningstar has displayed that. So JPMorgan Indian hasn't been working for a long time. We've talked about this before. It had a performance-linked tender planned for later this year based on what happened over the 5 years to end of September 25. They're going to scrap that, and instead, slightly earlier than that, that would have happened. They're going to do a 30% tender at more or less NAV, and then after that's complete, they're going to buy back stock to drive the discount down to single digits. Now, obviously, that discount's already moved, so they might not have to buy back very much, but that measure will be in there to sort of protect shareholders going forward. And then they're talking about doing another tender offer in 2028 for 100% of the fund at a 3% discount. So basically, you get the chance to get that 30% of stock this year, and then 3 years' time you could exit the whole thing. And they're saying if the whole thing dropped below £150 million, they will probably just do a wind up. So there's a continuation vote in 2029 anyway. Really, from a sort of trying to balance demand with the story, I think this will kind of make sense, and it probably should be applauded. To try and encourage investors to stick around, one of the things that they're changing is to introduce a much higher yield. So that would be 4% of NAV paid quarterly. And they're also lowering the investment management fee, so that actually boosts the income anyway. But nevertheless, the 4% of NAV is regardless of how much income they've got. But yes, that's all good news. Tick, tick, tick. We like all that. The problem is, though, and the reason why investors are agitated and the reason why investors want something like this to happen is because of the performance. And none of those measures we've talked about are designed to change the way the fund is run. And you can see there that it's quite a long way behind the peer group, especially over 10 years. So the big question really is anything going to change? And if nothing changes, then I would expect that everybody would really want to get out, and they'd rather get out now, sooner rather than later. So whether this actually satisfies people or not, I don't know. I might be being a bit mean here, but it does feel to me as though they could have been more aggressive than that. So that is enough from me. Let's now bring in Alan and find out more about Patria Private Equity. So good morning.
Morning, James.
Thank you very much for doing this again. As usual, I'm going to ask you to introduce the fund. So I'm going to leave you to talk for a bit, and then we'll get to questions from the audience. If you've got a question, please do put it into the chat box. Over to you.
Yeah, thanks, James. So Patria Private Equity Trust, or PPET, formerly known as Standard Life Private Equity and Aberdeen Private Equity Opportunities Trust, but changed its name around about a year ago when the management team joined Patria from Aberdeen. The trust itself was launched in 2001, so it's been around for some time now, and has delivered strong returns over that time period. It's a FTSE 250 company and has been focused on the European mid-market segment of private equity really since its inception. 1.2 billion of net assets. It also pays a quarterly dividend. The board is committed to maintain the value of the dividend in real terms. And per the performance, as I mentioned earlier, it's been strong for a long period of time. So 10-year annualized NAV total return of 14.9%. The share price total return over that same period is around 13.5%. Annualized, and since inception the NAV total return has been around 11% as well. So even since its inception, through the global financial crisis, through COVID, through this higher interest rate environment that we're in, this trust has delivered returns, and that's 14 consecutive years of NAV growth for the trust and counting. What we invest in, well, obviously private equity, obviously European mid-market private equity, but what we're doing is we're partnering with a group of managers, around 15 managers at any given time, that we consider best of the best. Some of the leading private equity managers that are differentiated in some way, whether that is through their sector expertise or thematic expertise, whether that's their value creation capabilities, if they have an in-house consultancy or a group of ex-operators that can really help support their businesses. We're looking for differentiated firms in the mid-market space, and we invest alongside them in their funds, and that's what the trust has done since 2001, but more recently directly alongside them into private companies, and directs now equate to around 27% of the book. At the start of 2019, there were no directs in this portfolio. It's almost 70% mid-market, and we're looking to grow that even further, and we want to increase our exposure at the lower end of the mid-market, and I'll come to reason why we feel the mid-market is the best place to play in private equity. And we're around a 3/4 European. This has been a European strategy from the start. We think Europe's got a lot of good qualities, and I think that a lot of people are coming around to that idea given developments in the macro space over the last few months. So really we're investing through funds, whether that's on a primary basis at the start of the fund's life, or on a secondary basis where we buy a fund part of the way through the fund's life, when we know what the assets are, the companies that the fund's invested in, but then directly, as I mentioned. So on to the next slide. Just to sort of labour some of these points on what we think differentiates this trust. So I've mentioned the fact that we are investing alongside 15 core private equity managers at any given time. There's quite an amazing stat that there are as many private equity managers in the United States as there are McDonald's restaurants. So you've got an enormous pool of people doing this. Around 15,000 globally is estimated, and we're partnering with 15. So we're being very selective and conviction-led in terms of who we partner with. Other features that I haven't mentioned, this trust has a flat management fee structure, 95 bips on NAV with no performance fee on top. Most private equity trusts have a similar fee, but with a performance fee on top of that. So when the times are good and the performance is very strong, that performance is flowing through in full to shareholders. I'll talk a little bit about the team and the change to Patria a bit later on. Another feature here is a diversified underlying portfolio. There are around 660 underlying private companies, but the top 100 companies are around two-thirds of the NAV as well. And lastly, I mean, I've mentioned the dividend, the track record. We've been undertaking regular share buybacks since the start of last year and invested around 20 million at last count into buybacks, providing good NAV accretion to shareholders given the current discount levels. So on to the next slide. This point around access, already mentioned it a couple of times, and partnering with a small group of private equity managers. Why is that important? Well, in private equity, to achieve returns that are differentiated from public equity, you really have to be backing the winners, the top and second quartile managers, and we're able to do that over 70% of the time, which is what the right-hand side of the slide is emphasising. If you just throw darts at a dartboard in private equity, returns can be pretty undifferentiated, but if you're able to access the winners, then they can be pretty meaningfully above listed equity. Over the slide, our team. So it's the former Aberdeen private equity team. Key message is that we've been doing this a long time. That's over 2 decades. In fact, some senior members have been investing in private equity for over 3 decades. So really strong network and experience in Europe and US private equity. We manage around $12 billion of private equity assets, and have relationships with over 300 European managers. There's been no change to the senior team since the acquisition of the team by Patria, other than adding Marco Diapolito, who's a managing partner at Patria, who now heads up our team. But no change since, I think, 2019 in the senior team. And in fact, the broader team has grown quite significantly since Patria bought us around about a year ago. We've added over 20 new hires to the team. The team overall stands at over 70 professionals, and around 30 of those 70 are investment professionals. So we've got a strong team that's been doing this a very long time. Europe. This was a more difficult question to answer. Why Europe? In probably the past decade than it is now. I think the key thing here is that some of the macro factors have changed. So if you look at interest rates in continental Europe, they're significantly lower than in the US, and that's quite important when it comes to private equity activity. The real GDP growth is accelerating in Europe. Obviously, the commitment to defence spending has repercussions across the continent, and things like Germany with increased spending. You've got the resilience of the Nordic region, and then places like Spain and Southern Europe, experiencing good GDP growth. There seems to be a bit of a turning of the tide and momentum in Europe than perhaps in recent years. But it's mainly this point around the interest rates, I think, is very important, and perhaps that leads to point number 2, why we've seen a faster recovery in private equity deals and exits in Europe versus the US. And I always see Europe as the home of the primary buyout. And what I mean by primary buyout is that's buying a business from a founder or a family rather than buying it from another financial investor. And I think through the cycle, there's always going to be death, taxes, divorces. There will always be a reason for people to sell businesses for the first time, and we see a lot of that in Europe. Less competition, I'd say maybe not less competition, but less intermediated processes, and credible competition would probably be the best way to put it, and lower valuations. And that stands to reason. I mean, the public markets in the US have been at a higher price to Europe, and the private equity market has reflected that in recent times. And so if you're a private equity firm that can take a local champion and turn it into a global business, you have the potential to achieve multiple arbitrage to the upside. ESG is a topic that divides people these days, but there's no doubt that European private equity leads the way on this. Europe was the birthplace of ESG, and so our managers are very focused on this, and sustainability generally as a theme. But lastly, this is the point, through the cycle, structural, more structural in nature. It's just a much more complex market to do business in, with multiple languages, tax systems, legislation, regulation. It's very, very hard to fly in and out and consistently win good deals in Europe. So it's about accessing the best managers on the ground, and that's what we offer our shareholders. So maybe we touch on why mid-market. So this is the private equity market from venture capital on the left-hand side. So perhaps businesses when it's more of a product than a business, that it's highly loss-making, and where you have the potential to make many, many times your money if it works, or lose your money altogether. So there's a high volatility. PPET does nothing in venture capital, and I think it's a very legitimate part of the market, but it's just never been our focus, and the volatility that you see doesn't lend itself well to making direct investments. At the other end, on the right-hand side, you've got the large mega cap buyout space, the Blackstones, the KKRs, the big private markets asset managers, typically doing deals of several billion enterprise value. we don't do much there as well. There's a couple of managers that have graduated from the mid-market into that space, but we do less and less at that end of the market. Where we're really focused in on is the mid-market, and that's businesses between around 100 million and 1 billion enterprise value at entry, where there's a lot of opportunity for growth. And if we turn over the slide, why do we focus here? Well, historically, it's outperformed, and we'll come back to that. But I think just like fundamentally, you look forward in an environment where interest rates aren't going to be zero, the mid-market provides a much more target-rich environment, less intermediated by investment bank processes, for example. That leads to lower pricing and lower leverage when an investment is struck. And the companies themselves, and there's many companies that can be targeted, and the companies themselves just have much more opportunity to grow, much more obvious value creation opportunities, as we say in this industry. So, as I mentioned earlier, alluded to, it can be a business that was owned by a family or a founder, where there's a dependence on one or two people, and the private equity firm can help implement a strong management team and a founder succession. It can be a business that's single product or service and is looking to expand its product set. It can be a traditional business that's looking to digitize. It can be something niche like a software business that's looking to move from a license model to subscription. It can be a business that's trying to grow internationally and grow via M&A. These are all projects that are well suited for the private markets and where a private equity firm can help these businesses grow. But then in addition, when it comes time to exit these businesses, you can exit them and sell them into the larger end of the private equity market, as well as the trade buyers, as well as IPOs. So there isn't that dependence on public markets as a way to exit your company and realize proceeds. And that means that there's a lower correlation to public markets as well. So if we quickly turn to some of these points, this is just reiterating this target-rich environment with thousands of PE firms, funds, and companies in the smaller space. So for this analysis, we've taken funds that are over 5 billion in size in dollars and funds that are under 5 billion. So pretty crude line in the sand, but I think makes the point quite well. At the larger end of the market, you have 300 funds that are over 5 billion, 120 private equity managers, chasing a lot of the same deals in intermediated processes. At the lower end, you've got 35,000 funds under 5 billion, 13,000 private equity private equity managers. So you can see the difference here, that it's very fragmented and there's a lot of opportunity. If we turn over the slide, so to this point around credible competition, dry powder is a term you hear a lot in private equity. Dry powder is essentially capital that's been raised for a fund but not yet deployed. Most of the dry powder in private equity has been captured by larger funds, and that's what the left-hand side is trying to demonstrate. If you look at funds under 2 billion, that part of the market, when you adjust for inflation, is barely growing. So that is an important factor. Funds that are larger attract more capital, get very large, chasing similar size, similar deals to one another in intermediate processes. But the smaller funds, the amount of capital there has remained pretty consistent. You look on the right-hand side, only 17% of M&A volumes are companies that would be considered larger cap, so over 1 billion enterprise value. 83%, vast majority are in smaller deal sizes under 1 billion EV. 2,400 companies. So there's a quite a big difference in terms of, on the one hand, the capital raised, and then also the opportunity set, and that's why mid-market we think is very well positioned as we look ahead. But if we look backwards, I mean, frankly, smaller and mid-cap companies grow faster. And it stands to reason there's smaller companies, there's more to do with them, And so you can see on the left-hand side the revenue growth in smaller companies, it's 2 times the rate of larger companies. And then EBITDA growth, earnings growth as well, follows a similar pattern. So these businesses have a greater potential for growth, a greater potential for value creation. And that underpins, obviously, the potential for returns. If we turn over the slide, just dwelling on the historic performance, frankly, even if we look backwards into the environment where interest rates were zero, smaller funds have outperformed. Now, it's a complicated sort of couple of charts, but just breaking it down very simply, again, taking that 5 billion fund size line in the sand, the small funds under 5 billion, they've generated an IRR of over 20%, 41% of the time. That compares to 17% of the time for larger funds. Now, my automatic reaction to that would be, well, surely there's more volatility in the smaller funds. You see a lot more underperformance, where in actual fact, if you look at the orange dotted box here, it's pretty similar. In fact, the smaller funds return an IRR of less than 10%, only 25% of the time. That compares to 30% in the larger end of the space. Admittedly, the larger end typically doesn't have loss-making funds, and you do see that in smaller funds. Around 7% have delivered a loss in terms of returns. But I think overall you can see that the downside is pretty similar. The upside, there's a big difference, and that's looking backwards in an environment where there's been a bit more of a free ride with interest rates at zero. Over the slide. So let's talk a little bit about PPET specifically and the performance. I mean, as I mentioned earlier, this has been around for over 2 decades. That's 14 consecutive years of NAV growth. The last 10 years have been annualized NAV total return of 14.9%. And that's your orange line there. And then your share price total return is the turquoise light blue colour as well. You can see how the lines have sort of diverged at certain points. You can see the global financial crisis, sort of 2008. You can see the start of COVID. And more recently, we've seen the discount widen with the rise in interest rates. And we've been investing more into marketing and investor relations to try and help get the message out there more. We've undertaken a buyback program. Our discount is around about 27-28% higher than the longer term average, but narrower than some of the other private equity trusts. We continue to work on ways to try and narrow that discount. But even with that discount, the share price total return has been around about 13.5% over annualized over the last 10 years. And then maybe over the slide, recent performance, our first quarter of financial year 25, solid returns in a sort of more turbulent backdrop. So share price total return 3.2%, NAV total return 2.2%. We've seen some decent exits in the quarter. Our first direct investment that we did in 2019, Mademoiselle Dessert, a manufacturer and distributor of frozen pastry, that was sold to a Swiss trade buyer for around about 2 times original money. We also saw a fantastic exit from Gritec, a German infrastructure services business that was sold to a German family office for around about 13 times original money. And we've seen a handful of other exits during the quarter as well. Those exits were an average uplift compared to the valuation 2 quarters prior of around 52%. And I think that's a really important point around private equity. A lot of headlines about valuations. Certainly in our portfolio and many other quality buyout portfolios, what you tend to see is that average uplift upon exit. So 52% in the first quarter, admittedly a small sample size, but last year it was 26%, the year before that 19%. Over the long term, we tend to see an uplift of 25%. I think that the proof is always in the pudding when assets are sold, and on average they are sold at an uplift. Over the slide, just to touch on some of the largest portfolio companies. So the first thing I would say is that the underlying portfolio is performing well. If we take the top 100, so around about 2/3 of portfolio value, that's growing very strongly and very similarly to the top 10, in fact. So we're looking at sort of low teens revenue growth and EBITDA growth in the high teens or even early 20s. So still seeing that underlying growth. Admittedly, some of that is through inorganic M&A, but organic growth remains on average in our book. So we're delighted about that performance. Our largest position remains Action. Many of you will be familiar with that business through 3i. We've invested alongside 3i in that business since 2011. It did fantastically well for us, made over 30 times our original money on that, and then reinvested half into a direct investment. As a reminder, this is a discount retailer, non-food typically, and across I think around about 10 countries in continental Europe now, and continues to grow its new store footprint very strongly indeed. Sells a range of stuff, whether that's massage guns, gardening equipment, gym equipment, non-perishable items. It's a wonderful business. Certainly not mid-market anymore, but it started as a mid-market business, and we took a little bit of money off the table with Action, but it remains our largest exposure. But just to give you a bit more representative feel of what we have been investing in and what we will continue to invest in going forward is things like Woundex, which is a healthcare services business in Germany that treats complex wounds outside of the hospital environment. This is really a root density type business where nurses, the more density you have, the more profitable the business becomes, and it is a fantastically run business. It's performing ahead of our investment case. This is a direct investment as well, and this could be an exit candidate over the next 12 months. European Camping Group is our third largest position. Does what it says in the tin. It operates campsites across France, Croatia, Spain and Italy. And recently that had a realisation event with Abu Dhabi Investment Authority coming in and taking a significant position. So we've taken most of our money off the table, around 2 times our money, and we still have a little bit more in there to capture further upside. That's a business that's performing very well and was really our play on the recovery in travel and leisure post-COVID, and so we're really happy with that company's performance. I'm not sure we've got time to go through all of them, but just to sort of quickly summarise, you've got businesses like Visma, which is also in the HG Trust. It's led by HG. It's a fantastic ERP software business, cloud-based, and we're very happy to have been an investor in Visma for the last 20 years or so, and as it's grown. Gritech, I mentioned earlier, has just recently exited, so it's a large position in our book and has performed very well for us. Things like Uvesco, small premium grocer in the Basque Country that has been expanding across Spain. That business is potentially interesting to some of the large trade buyers in this space, the large supermarkets. So watch this space. Ferneri is one of the largest ice cream manufacturers on the planet. And then you've got things like NAMSA, which is a contract research organisation that basically does the testing of new medical devices for manufacturers. And then CFC, which is a managing general agent in the cyber insurance space. So obviously with things that have been happening with Marks and Spencer, etc., very relevant that companies have insurance to cover that risk. But the cohort continues to perform very well. Our top 10 and our top 100, our portfolio continues to grow nicely. Over the slides, I mentioned dividend. Just conscious of time, the dividends increased by 5% this year. Last year it increased 5%, and the year before that by 11%. The board is committed to at least maintain the value of the dividend in real terms, so it's a yield of around about 3% and paid quarterly. And then over the slide, share buybacks, we've been active here. This amount invested is more like 20 million today. We are, or the board and the manager are committed to continue to buy back opportunistically to create additional returns for existing shareholders, but it has also had the added benefit of kind of keeping our share price discount as tight as possible through this period of volatility. And I think that's it. I would turn over the slide. So to sum up, performance that's been around for, a trust that's been around for over 2 decades. It's delivered strong performance over the long term. We are mid-market focused. Our conviction in the mid-market is only increasing as we look ahead to an environment with more normal interest rate levels. The trust is becoming increasingly direct, 27% of the portfolio in direct investments, flat management fee, quarterly dividend. And James, I'll pass over to you for questions now.
Great, thank you very much, Alan. We've covered a lot of ground, but I think, it's all very interesting. Sort of structural stuff first. You've got a little bit of North American stuff. Would you ever invest in Asia?
Not directly. I don't want to say ever because, that's quite definitive, but we haven't directly invested in Asia at any point in this trust's life, and we've found the Asian private equity market quite volatile, shall we say, and frankly it's not the manager's expertise either. So we've stayed away from that. That's not to say that some of the funds haven't gone into Asia, and we have a very small exposure, I think principally to India, through some of the larger funds. Advent International, for example, they have a mandate to invest in India. So we've got probably about 2% of NAV that is non-US, Canada or Europe, and that's principally in Asia and principally in India.
Great, thank you. US, obviously there's a lot going on, tariffs and stuff. Are you particularly concerned about the economic outlook there? Is that something that you kind of factor into your decisions, or actually the company's kind of making their own luck, if you like?
Yeah, I think it's you're always paying attention. I think what private equity does tend to do well when there's periods of volatility, it tends to buy very well. So we don't try and time the market, and this is principally European focused as well. So and because of the mid-market nature, there's few businesses in our portfolio that are really exposed to, kind of exporting into the US. I mean, we looked at our book, very, very few assets are directly impacted. Obviously, the second order impacts will affect almost all businesses. So no, I mean, we try and stay invested through the cycle. We tend to find private equity, people come into private equity at the wrong time, at the height of the market, and then come out straight away as soon as the cycle turns. And the best thing to do is stay invested through the cycle. I think the main impact on our portfolio and our considerations right now as a result of what's happening in the US has been more around private equity market activity, which was nicely recovering in the second half of 2024, and we expected that to continue into 2025. But really seen a complete slowdown in M&A activity, whether that's private equity backed or whether just generally, as the uncertainty levels have been very high, that people can't make investment decisions. And so starting to see a bit of a recovery in activity now with a bit more certainty, but I still think it's going to be a quiet half of the year, which is rather unhelpful when you're thinking about portfolio exits and getting new deals done. That's probably been the biggest impact, and that has a knock-on impact in terms of how we consider the management of this trust from, in many ways, whether that's balance sheets, because we're receiving less distributions or expect to receive less distributions with less deals getting done, whether that's on the new investment side, do we need to cut our cloth accordingly, so that's been the main impact. Really, we're 3/4 European anyway, and we have no plans to change that. So So yeah.
Great, thank you. Normally these funds run kind of 10-year cycles, but investing directly means I suppose you can hold things for longer. How long do you think you'd ever hold something for? Are you generally trying to recycle the money every 5 years, or how's it normally work?
Yeah, so some of it is definitely placing reliance on the underlying managers and their focus on returning money. And so DPI, as they call it, it's basically the amounts distributed back to investors relative to the amounts paid in. That has been a huge focus area in terms of our recent diligence of managers. So we really want our managers to be focused on returning money through the cycle. So you place some reliance on them, but I think that'd be a weak answer if that was the entirety of it. What we tend to do now, or what we've done for certainly as long as I've been involved, is be proactive around our portfolio management. So what have we done? We've proactively sold some of our position in Action for portfolio construction reasons. That returned some money to the trust. We've sold out of things that have underperformed without naming names in terms of managers. There's been a couple of positions that we didn't like developments, and so we sold on the secondary market. But the best example was probably last year, where we sold a book that was valued around 180 million sterling. It was a book that consisted of very tail end funds. So they've been held for 10 years or more. But it was also a book that consisted of larger cap investments as well. And we sold that at a 5% discount to NAV to a large secondary player. And that allowed us to accelerate money back into the trust with a bunch of assets sold that frankly we didn't have enormous conviction would drive strong investment returns from here. So we're proactively looking at the book and making secondary sale decisions all the time. We did a similar one in 2019 as well and cleaned up the tails. So yes, some of it's definitely the underlying managers that we partner with, making sure they're focused on their fund management and returning capital, but we're also proactively managing it as well.
Great, thank you. Action. With it just being relatively large investment now and you holding it directly, is that something that you can monetize quite quickly, or is there have to sort of wait for an event that in the company that lets you do that?
Yeah, so typically 3i have provided liquidity windows where they've basically facilitated a matching service between buyers and sellers, and then the price is basically the value of the asset. So it's pretty well known that that's valued at around 18.5 times EBITDA. So the line in the sand is very clear, and that you can definitely trade in and out. There's certainly a lot of investors in Action now, so you can trade in and out pretty easily. So should we want to, I'm sure we could sell out of that very, very quickly indeed. But when we made our most recent decision around liquidity, we asked our direct investment team to completely re-underwrite Action as if it was brand new. And it's just a wonderful business, and it's a very, very large business now. But I mean, the opportunity for it to grow just within Europe is substantial, and it's so well run. And even discounting the Asian opportunity or even the US opportunity in the future, just how much runway it has for growth in Europe is terrific, and the model lends itself very well to a more challenging consumer environment because of its low-cost nature. And the beauty of it is it's sort of virtuous circle that the bigger it gets, the better terms it gets, whether it's landlords, whether it's the suppliers of the product, and so the performance just keeps rolling on. We just took a view, 18 months ago that it's very, very large as a proportion of our book, and it made some sense to take a little bit of money off the table. We've done very well. Shareholders in PPET have done very, very well out of Action, and so it was more a portfolio construction call.
No, great, makes sense. Um, Now, one of the sort of biggest changes recently has been the sort of what's happening in Germany in terms of them pumping money into the economy. Do you think that's actually going to be beneficial for the portfolio?
I think it will be for the underlying performance of companies if it stimulates GDP growth. But I think private equity is quite a micro industry. I think the opportunity is really in the Mittelstand type companies and that sort of founder transition. Germany, despite being the largest economy in Europe, has been a tougher private equity market. This perception of private equity it's not been as well received as, say, in the Nordics or the UK or France or the Benelux. It's been a tougher market to source effectively. But I think that's starting to change, and a couple of the assets I talked about earlier, things like Windex, like Ritec, have been amongst our best performers. They're German assets. But yeah, for sure, I think with Germany spending more and defence spending, and that all helps general growth, and that'll help underlying performance, I'm sure, of the businesses. But ultimately, in terms of sourcing good opportunities, it's working with managers, navigating through that middle stand part of the market where there's healthy skepticism of private equity still, I think.
You talked quite a lot about Windex. Windex, is that right? So, what's the sort of long-term plan for that company? How's it going to grow from here?
Yeah, it's increasing the route density, I think, because as it operates a sort of hub and spoke model. I think the biggest challenge historically for this business has been getting enough nurses, frankly. That's been more the constraint for it. But frankly, we're well ahead of this initial investment plan here. So optimizing that route density is probably the key thing. It's a very German business. It's quite unlike many of our businesses that operate across Europe or certain regions in Europe. But this is one that's perhaps in the exit lounge, without preempting anything or saying anything I shouldn't, that like it is, because it's so far ahead of plan, and always has to be a story for the next buyer. I think it's one that the manager we're partnering with, Capiton, is looking at as an opportunity. So yeah, I'm not promising anything, and it's not my place to say, but I think it is one of those that when there's a bit more activity in the market, a bit more certainty, frankly, on the back of the tariff stuff, that it might be a short-term exit opportunity.
Now, you talked about it being a slightly harder environment to sell things in America. Do you think the opposite is now true in Europe, given the sort of stimulus that's happened and it's all a bit more racy than the US is?
I think, yeah, back to that slide I presented earlier, I think look, across the globe right now, this half of the year it's been tough. Whether it's US, Europe, there's just been so much uncertainty, how the tariff thing is going to play out. We're starting to see, hopefully come out the other side of that, we're starting to see or hear of processes restarting, and credit markets are there again for new opportunities. But look, it's definitely had a negative impact in Europe as well as US. I think though, going forward, I think the fact that continental Europe has lower interest rates is significant, because interest rates are very important in private equity, where you're using an element of leverage and making the numbers work there. And certainly the sentiment has changed towards Europe enormously over the last few months. And you're seeing managers like Thoma Bravo, one of the largest software investors on the globe, basically saying they're going to be doing more in Europe. You're suddenly hearing from people, investors, saying, we want to do more in Europe, what are you doing? But the sentiment has say, flipped, but changed significantly. And so it wouldn't surprise me if Europe is a bit more active, and it has recovered more quickly from the rises in interest rates than the US, as I showed earlier. So I think the outlook is as positive for Europe relative to the US than I can remember.
Great, thank you. I think we've probably more or less exhausted the questions there. I'm not going to ask you to. Well, actually, maybe you can. Why do you think you should buy PPET rather than any other private equity trust?
Well, I think it's what I set out earlier, really. I think the mid-market focus, that is a key part of what we'll do. We'll do even more in that, and a very strong conviction that that will outperform and continue to outperform it as it's done in the past, for all the reasons I set out. PPET also pays a quarterly dividend. It's done so for over 10 years. That's also a factor as well. The flat management fee as well, we're amongst the lowest cost in the space as well. And I think Europe going forward is going to be very, very interesting as we look ahead. So those are some of the reasons why I think PPET is interesting. But I would say, look, private equity managers in this space are good managers. They've been managing their trusts for a long period of time. I think not enough people hold private equity generally. I think it's got a very strong place in a diversified investment portfolio from a diversification point of view, but from a returns point of view as well, and accessing the 28,000 companies that are owned by private equity buyout managers. So yeah, I would encourage people to invest more into private equity generally, and obviously I'd love it if that was PPET.
Brilliant. Thank you very much indeed, Alan.
Thanks, James.
So there's lots of additional information there for you, which you can go back and read. And I shall probably just mention that we'll be back next week. And we've got a panel session next week. So actually, we've got your colleague Harish is going to be on. But we're
Lovely
talking
guy.
about we're talking about a slightly different angle. Really, how private equity companies, small cap companies, how they support management, how do they grow businesses, what makes a good growing business. That's really the angle next week. So in the meantime, have a good weekend. Enjoy the bank holiday, and we will see you next Friday. Thank you.